Good morning, students. We are going to we have completed the syllabus content last year, last month, last week. Only thing we are going to discuss some relevant past papers with you all. I think all past papers have been uploaded. Before we move into past paper discussion, I just give summary of all these syllabus contents we have done with you. Basically, we have started your syllabus contains with the theory part, that is basically evolving of investment banking. So the evolving part I have not done with you all. That is basically theory part. So only thing there are a few questions. So I will be uploading these questions during this week with the answers. You don't want to do much uh, attention. You don't put much attention to these questions. Just go through and just have an idea how the examiner will, how the examiner tests you some kind of question. Now this was actually uploaded to the website 2014 only, right? So the way back. So now that's why I told you don't put much attention to these questions, but only thing just have a look at. So these are the questions examiner has suggested when the new syllabus is started, right? So basically, these are the things we have done so far with you all. I just give a brief introduction with you. And if you can remember the first one, evolution, that one we haven't done with you all, so only theory part. I will be uploading some questions to the actual I promised to upload, but I have not uploaded. So don't be distracted by having or by looking at these questions. Just have a look. I will be uploading these 12 questions during this week. And only thing, just have a look. Don't do too much because this has been uploaded 2014 only, right? So the way back. Just have an idea. These are the examiner wanted to test the model type of questions, right? Model questions. So the issue management, and the issue management we have done with your equities and the debt securities basically. So the equity shares, debt security is basically a debenture we discussed, right? And also we have discussed some government security instruments, treasury bill and treasury bonds. Treasury bills we have done the features with your short term, treasury bonds, it's a long term instrument. So both the options are, both the instruments are auction based. So then also we discussed the import matters only I discussed with you, right? Then the important thing is the pricing of these two. Only thing examiner has not tested pricing of treasury bills. Treasury bonds, yes. Then just have a look at the formula we have given to you to calculate treasury bills, right? And another one is the features. Sometimes examiner can test you features, and also the relationship between yield and the price. That is also important. And when you get a question to answer the pricing now, when you in terms of pricing, treasury bill is always at a discount, right? Remember the word I also stressed you, always a discount. So the treasury bonds or debenture, it can be par, it can be discount, can be premium. Treasury bill is always at discount. So then you should understand when you get an answer for the treasury bond calculation, that is dirty price. So when you ask to calculate clean price or accrued interest part, then we have discussed how to do this. Right? Accrued interest part, how do you calculate from the last coupon date to the settlement date or the purchase or the selling date. So that part of course belongs to whom? Seller only. But what happens is from that point onwards, so the entire 6 month coupon, I'm talking about the treasury bonds, right? The coupon is anyway has to be 6 months. Treasury bonds issued by the government. Debentures, of course, privately issued that can have different interest rate bonds. But treasury bonds, it has to be always 6 months semi-annual. So the what happens is new the central bank will credit entire 6 month coupon to the new buyer, which is wrong. So the from the last coupon date to the selling date or the purchasing date has to be credited to whom? Should be given to the seller, but it doesn't happen. It is not happening. So then that part we call accrued interest part. So how do you compensate that? Through the selling price only. No, right? That is part. That part, of course, exam has not tested that particular part. Right? So the accrued interest part and what is the legality of who will be now if the examiner asks for two mark question. Now who now this accrued interest part belongs to whom? The seller only, not the buyer. Right? But he was holding this particular instrument for that such time. Right? We have that discussed and the treasury bill, of course, discounted instrument, the features we discussed, bond features discussed, and now treasury bond and the debentures are almost similar, only the issue is different, right? Only the issue is different. There are few changes, there are few differences. I have given in the tudes notes, just go through the differences as well. Then the debt instrument debenture. So the debenture, there are some words we discussed: oversubscribed, oversubscription, undersubscription, underwriter, right? Then the tier one instrument, which was not tested so far, tier one instrument, right? Then the perpetual bonds, remember, perpetual bonds, and there is no maturity. It's perpetual, indefinite maturity, tier one instrument, right? So the why we are issuing tier one instrument to get the amount to the capital and the Basel III, right? So then, then now for example, now say if the bond is now there is a bond, normal bond, you're you're purchasing at a premium. Premium is more than 100. There is a bond you are purchasing at 110 example. But is it worthwhile for you to purchase? Why? End of the period, I'm talking about the normal bond, not the perpetual bond. Government bond. It is maturity, government bond. And after 5 years, there's a 5 year. After 5 years, how much you are getting? Only the face value, which is 100. But here you are paying now 110. Is it worth? There can be a question. Now, there can be a question in exam, paying or the purchasing at a premium is a profitable or is a wise decision, is a feasible decision for the investor, or at least they can have text type question and giving a story, and this guy is purchasing at 110, whereas on the maturity he is getting 100. So that somebody is saying this is not a good decision, somebody this is a good decision. So the examiner can ask you what is your view. That can be possible. So then even you pay at 110. True that you are getting on the maturity of the maturity 100, which is the face value, but when you calculate sometimes, it is profitable. So how do you say? How do you know that? Now we discuss purchase yield and the selling yield. Now in the exam, that particular question, examiner, if the examiner gives you, no, this the particular buyer has purchased this particular bond at 10%. Now he is going to sell at 15%. Then obviously without anything, you know that the seller is making losses. Why? Yield has gone up from 10 to 15. Obviously price should come down. He is selling at loss. That part we discussed. So the understand important part is the relationship. Whatever the other informations are relevant or irrelevant, but understand only the relationship. So based on the relationship, we can decide whether this is profitable or not by selling this particular bond. So then now that is from the seller side. That is from the seller side. Now the question is now say I am purchasing at 110, whereas I am getting at 100 on the maturity. For me, for buyer, obviously seller side is a loss. 100 day got there, 110 one it's a loss. Right? Tell, think about the buyer side. I am purchasing at 100, but I am a buyer. Still, I am getting on the maturity 100. Is it worthwhile for me to buy? So that depends. The entire thing is dependent on what purchase yield and current market yield. Here, the current market yield will be what? Discounting yield. That's the current market yield, right? During the question, remember that we made some discounting. So that is the present current market yield. So this rate only, the new guy is going to be purchased. This particular rate, discounting rate, is the rate that seller is going to be sold. You got it? So that is basically the market price. So sometimes actual market price may be different from the his discounting or the required rate of return. That's different issue. But the examiner has given you, okay, this is the required rate of return, which is what? Discounting factor. So here we are taking that as a market yield. So then that is the market yield. You have purchased at this price. So then you decide whether this sale is profitable or not. So then we moved into we move into shares. Shares is also important now. Share market is everybody is talking about the share market, and the indices we discussed, and also we discussed some boards with you all, and the requirement of listing on this board also we discussed, right? So everything I have uploaded these things, and just go to the past notes. Shares, of course, different types of shares we discussed, and also the different types of features we discussed: bonus shares, right issues, then the share splits, scrip dividend, all these things we discussed, and the number of the features of shares, voting shares, non-voting shares, and what are the features and the preference shares we discussed. Important part is secondary market, primary market, and the methods of being listed through IPO, introduction, for sale. Remember that? Prospectus sales, right? And we have discussed some pros and cons of these different methods. Private placement is another method of being listed, and private placement and IPO, two different things. You are inviting entire public to invest through IPO, but you privately do this through private placement, right? So nobody knows. So advantages and disadvantages. The examiner can ask you, so what is the advantage you are getting by having IPO than private placement? Obviously, you can speak to many. So if you are giving IPO, initial public offer, you are inviting entire public to invest. But private placement is only few people. You personally go and speak to them. Then you can have what? Ultimately more capital. So why you want to be listed? There are few things, right? So the first thing is what? Get capital. Then you can address more investor base. So everybody will come and invest. Put capital. Buying shares means what? Capital, putting capital. Buying ordinary shares means putting capital. Right? You become a shareholder. Now when you purchase a share of joint share market from the share market, you become an owner. So share market, all these shares are ordinary shares. It doesn't matter voting or non-voting. They come up now. At least we are holding a voting shares or non-voting shares, ordinary shares. Then you become a true owner. Right? True owner, so that you will be getting what? Dividend. Right? There is no maturity for shares. Like the government securities or G6, like debt instrument, debenture, there is no maturity for shares. And there is one particular instrument, debt instrument, which does not have maturity, what? Perpetual bonds. Right? There is no maturity, indefinite. Right? Perpetual bond, remember that we discussed, and then we discussed the convertible option. When you issue debt instrument, so after sometimes you have the option to convert into shares, right? So that all these times you have been paying interest. Now once you convert into shares, you become a shareholder, then you will be getting what? Dividend. So that part also we discussed. And types of shares, number, the preference shares features important. Preference shares also kind of shares, but different from ordinary shares, right? Then we discussed the asset securitization, sorry, the structure of assets. Now, say somebody comes and asks you, so I need to have capital. So then, what is your view? I need to, I need to initiate a project, but I don't have money. So can you help me to find money? So the people will come to you while you are working in the investment banking division. So the people will come to you and ask. So the suggest me a solution, suggest me a alternative method for me to find capital or for me to find funds readily. For me to find funds, he needs money. Then you decide, you advise him. Is it is it is it is it you are basically advising, you can advise, go for a capital infusion or debt instrument. That is up to you. Sometimes investor also can decide it. Now there are two options, right? To get funding, it can be through share issue, it can be through debt instrument, debenture. Can issue debenture, you can issue shares. Or you can organize a right issue. Also come money. Then if the now what is the difference between these two? Examiner has frequently tested this. So the why you are issuing, why you are asking to issue shares rather than debenture? Many things. Why you are asked to issue debenture rather than issuing shares? Many things. So the first thing we discussed, the important thing is we discussed the dilution. Right? When you issue shares, the existing shareholders are not subscribed. What happens is the existing shareholder percentage is diluted. So the existing shareholders sometimes don't like it. Sometimes they don't like it. So then the option is to go for borrowing. But at least you can have kind of debt capital as well. Why? When you have debt capital, you have to make payments of interest. When you have interest, the amount you derive, the amount you will be receiving, the amount the company is deriving or basically the earning as capital is reduced. Why? Profit comes after deducting the interest expense. So then when you have lesser profit, you have a which liability? Tax liability low. Tax liability, lower tax liability. So then you have a tax benefit by issuing debt instrument. That part also we discussed. Right? So then the debt equity ratio, based on the debt equity ratio, you can decide how much we should leverage. So how much the company should have debt capital. So the excessive debt, disaster, right? Remember that we discussed the capital restructuring. You have a capital, then this much you have capital, then you have excess of debt, finish. Don't go too much debt capital, but at least you can have this debt capital to some extent. Why? There are some benefits, right? And then you decide, is it the money has to be through capital or debenture. So structuring part has to be done by you, right? Structuring part has to be done by you. Structure the, if it is a right issue, what is the price? And if it is share issue, then you have to, if it is an IPO, then you have to print what? Prospectus. Prospectus is what? The document which contains all the information about the company. Why you issuing prospectus? You are invited by through prospectus, you are inviting third party to invest in your share, in your company shares. So the third party should know everything on the company. How does he get to know? Through prospectus in terms of in regard to the share, right? So basically, it contains everything about the company, the utilization. I showed you to HMB prospectus. Remember the first lecture. So contains. So it contains a lot. So basically, for you to take a decision about the company, whether you will be investing in the shares of this particular company. Oh. And another thing is the ratings. We also discussed the ratings, importance of rating. So the why you want to be rated. That is also you are giving information to the third party. Okay, so this much we are stabilized. Anything you put us, anything you give it to us, this much we are stabilized. If it is triple three, you are fully stabilized. So the people are not worrying about investing, or people are not worrying about giving deposits to your bank. If it is triple A rating, people are not worrying about investing your shares. 100% sure that you will be paid. People are not investing. People are not worrying about investing the debentures of your bank if you are having triple A rating. They're 100% sure that stability wise it is perfect. So there is a guarantee that this company is going to pay back you on the maturity with the interest. Right? So that's the confidence is there. So the third party, that is another indication. So basically another encouragement. So to bring the third party to invest in your whatever the instrument you issue. It doesn't necessarily be shares or debentures, but whatever the instrument you issue, all the instruments now these days, if you have seen these days, all the instruments are rated. Right? So basically the purpose is what? You are giving confidence to outsiders. Don't worry, you invest here, we are safe. Right? So we have two rating agencies, Fitch and ICRA locally, and foreign we have S&P, Fitch, Moody's. These are the three agencies we have worldwide. So what they are doing is they are actually basically grading the country. Those rating agencies, foreign rating agencies, grading. It can be upgrade, it can be downgrade. They are doing the grading of a country, of countries uh, to their rating. So that is the rating agency's task, right? They're giving an independent opinion. Then the structuring part important, whether if it is debenture, whether if it is yeah, and also the time. So when you structure uh, structure what you call structure instrument, time is also important. What do you mean by that? Very important question, right? Now say now if somebody is willing to fix. Now the guy, now you have decided to issue debenture. Now example. Now you are going to issue floating rate debenture rather than fixed rate. There are two types, floating and fixed. You can have both. Now you as a issuer, remember the word. Issuer stance is completely different from the investor. Always think about the issuer side. Always think about the investor side depending on the examination question. If they ask from the issuer side, of course, completely different issue now. If it's a debenture, think about the issuer, he needs to pay as much as low interest. If I'm the investor, I need more from the company. So the two different alternatives, two different what you call purposes. So then if it is now think from the issuer side, so the issuer wants to issue a debenture. Now the present scenario, today we are in October. If you are issuing a debenture now, are you issuing a debenture fixed or floating? You can have both. You can have both, but you as a issuer, you like to have fixed now. Why? Interest rate is going up. The one policy rate increase also happened. So there will be another hike. And also, you can remember, I asked you to go and have a look at the is the treasurable option which is available on the EPSL website. If you go and see this, now the 3 months treasurable rate is going at 8.04, 8%. How much your bank pays for 3 months treasurable, 3 months FD? Can go and have a look. It sometimes 3% difference. The bank pays 5%. I don't think the bank pays 5% for 3 months, 3 months, lesser than that. Some banks are paying. But here the treasurable is paying 8%, which is completely risk-free. Which is completely risk-free. Why the government is not defaulting? Which risk is free? Default risk. Or credit risk, credit risk is free. Default risk is free. Issuer risk is free. But other risks we discuss: reinvestment risk, inflation risk, liquidity risk, interest rate risk, everything is there, even at a risk-free rate, right? But this risk is completely free. Now what happens? The people are moving to these products, so they don't come and invest in your bank FD. You got it? So the tendency is what? In interest rate or the treasurable rate to go up. So the variable rate is basically what is the reference rate you give? What is the reference rate? Now when you structure variable rate for debentures, you take 6 month treasurable rate plus whatever the margin you decide. So the 6 month treasurable rate plus 6 months means every 6 months this rate is reset. Every 6 months this rate is reset. Now say if you are issuing a debenture 6 months, other issue करना 6 month treasurable rate plus 2%. अदा आप इनको 8.25 8 plus 2%, 10.25. So ඊළඟ මාසය කියනවා 10.25. ඊළඟ මාසය ගියාට පස්සේ then you have a new treasurable. Treasurable options are weekly, right? Then you can have ළඟම තිබ්බ treasurable option එක අරගෙන 6 month rate එක බලනවා. එතකොට අපි කියලා තිබ්බොත් එimhe 9 කියලා. So 9 plus 2 11. Previous 6 months you paid how much? 10.25. Now you have to pay 11% for next 6 months. So what happens? When you issue a debenture under floating, you have to incur considerable cost. You have to incur considerable loss, right? So the cost is escalation. Cost is escalating. So then you, the investor is asking 100% sure now variable. He's asking variable. Why? He knows interest rate is going up. Interest rate is going up. So then basically people will not put at fixed rate. So like that. So time to time it changes. Time to time it changes. Now earlier days people like to fix it. Why? They had a vision. They had the idea that the interest rate will come down. Then it is better to invest fixed instruments. Now they have changed it, obviously, right? So basically, how do you decide this? Remember that we discussed yield curve. There are 4 types of yield curve. So based on the yield curve, you take decision whether you will be issuing the timing. Are you issuing now? Are you wait to issue this particular instrument if you are not in a hurry to issue? Right? If you are not in a hurry to issue, if it is you want to anyway issue, then you have issue. But if you don't have much requirement, then you can wait for some time in the interest rate to less. But I can assure you that in the coming years, in the coming months, interest rate will reach the highest. So when the interest now see why interest rate goes up, foreign counterparties come and invest in government securities. So they should have more yield, otherwise they are not coming. So when you have there is a relief to the exchange rate as well when you invest when you have increased trend of yield, right? So then that's that. So many things we discussed. Those are the few important things only I just highlight to you. Then the underwriting we discussed and the methods of underwriting. There was a question last year, the previous day. the methods of underwriting and then the asset securitization. Sorry, I missed that. What we last week we discussed. So how asset securitization, leasing is the classic example. So that avoid the mismatch, right? And also remember that field I have given you the party involved in this asset securitization, which is most very important. And also I discussed the method of and the products. Another, yeah, no, basically matching the mismatch, right? So the leasing, we have given some examples. The leasing auto loans is the similar one, and the credit cards, the receivable, and the student loans, and all these you can securitize. The only thing, once you make the payment at once, then you get installment basis. To mismatch, then you have new product, new issuance called securitized papers. So the SPV is created, remember, and then you can have this. So the CR, certificate of registrations on the UK can be security. Then the underwriting we did it. Underwriting is what? Basically unsubscribed amount you subscribe. So before you issue, it is there for shares, it is there for debenture, everything you can have appoint. You can appoint this underwriter. So the task is what? Which is unsubscribed. Whatever the unsubscribed portion will be subscribed or will be purchased by underwriter. So the corporate finance service, loan syndication, so that if you can't give one loan, then you get to then give. That's loan syndication. More syndication loans are generally can see in the foreign markets, right? Where we don't see much, but it is. We don't see much in local markets. We don't see much in local markets. Uh, we don't see much in local markets in loan syndication, but there are some occasions. If one somebody comes and asks a customer of a small bank comes and asks $10 billion or $5 billion, then this bank can't give 5 billion at once. But what happens is you get together and give, right? And arranging leverage buyout. I have given these terms meanings for you: leverage buyout, management buyout, LBO, MBO, and important notes, right? So please go through these. This now the notes I have given you are very summarized and concise forms, right? And there are few text type things for you to read. So if you read this, you get something. So don't miss any notes which I have given to you. So investment advice and also many things right now, the mandatory offer and all those that I have not discussed with you, but I have given all these notes to you. The compliance or the compliance of 30% swap card, 30% of particular compliance, then you will have to offer to the other shareholders whether you will be purchasing, you will be selling to me like that, right? The mandatory offer. Those are the terms we are using, and also the malpractices of front trading, then insider dealing, churning, wash fishing, like that. Many things, right? Investor advice means what? The broker. So here we are taking only the broker's advice. So when you want to open account, serious account. So what is serious account? When you want to invest in listed instrument, you should have serious account. Debenture you should have. If it is listed debenture, you can't invest without having serious account. Shares, of course, you should have serious account now, right? And also remember the new coming. I have given you paper article for you DVP, delivery versus payment. Recently, the central bank, SEC has introduced for the settlement method. If it is important, so the earlier days, once you sell shares, share goes out, but you will be receiving money after T plus 2. But here the money and the this one T plus 3, right? The money and the security will be simultaneously exchanged. So the broker means what? So the broker is every investor has a broker. So basically you will be giving instructions to him. Now he is doing the malpractices, right? Now share market malpractices are done by the brokers only. There are 28 brokers. How many primary dealers? We have 10 primary dealers, banks plus companies. What is the importance of primary dealers? So they are being given the license to participate at the treasury bill treasury bond auctions. But what about SLDB? SLDB that is also auction, but primary dealers la wenna onne auction ekada, right? SLDB. Remember that SLDB is what? Dollar denominated instrument issued by the government, Central Bank of Sri Lanka on behalf of the government. AKD, we are calling not the primary dealers but the paying agent or the designated agent. So all banks are designated agents. ඕන බැංකුවකට කියලා දෙන්න පුළුවන් මේක මගේ application එකේ තියෙනවා why මගේ can individual invest in SLDBs? Of course you can. There are eligibility criteria. I remember that I gave you advertisement for lectures. Go and see the eligibility criteria of investor. If you are holding more than 10,000 rupees in your PFC account, you can invest in SLDB. That actually, and that is the eligibility criteria is here, right? So basically, you will be investing. So fill the application and give it to you, give it to any bank. So that they are the designated agents. Only paying agent means what? Paying agent means the bank who pays the coupon interest. Now there is a coupon, SLDB coupon either fixed, either variable. If it is variable, reference rate is what? LIBOR. Remember the treasury bill, treasury bond. No, when you issue, when you issue a debenture, variable interest, rupee. When your bank issuing a debenture, rupee. What is the reference rate? If it is variable, treasury bill, rupee. But SLDB, dollar denominated instrument. If it is variable, you can have fixed and variable both. If it is recent past, we have not seen fixed variable. Earlier it was. If it is variable, then the reference rate is what? LIBOR. Now LIBOR is also going to be scrapped by end of this year, and there will be a equivalent successor for that, right? That's a different issue. Then the LIBOR is common. Now then if you are issuing dollar denominated instrument, then you have SOFR, SOFR. Then you have SONIA called GBP instruments. So different rates, different currencies, different rates going to be implemented. Now the LIBOR is going to be scrapped. So anymore LIBOR is not going to work future, right? So then reference rate at the moment is LIBOR, right? So basically that is variable rate, LIBOR plus whatever the margin. Same thing as our debenture variable, right? Only the rupee, only the currency is different. Only the currency is different. So that's keep in mind. And also then the financial, the investor advice. So again, I want to highlight you. Sometimes now you know when you invest in shares, secondary market, you can have broker credit. Now say you are maintaining 1 million share portfolio. ඔක්කොම shares වල invest කරපුවම ඒකේ market value එක 1 million. Example. So then සාමාන්‍යයෙන් broker credit means broker company. Broker company ඔයාලට දෙනවා ඒකෙන් සාමාන්‍ය අපි කියමු 30%. තව 1 million 300,000 ඔයාලට නිකන් දෙනවා. You can, they are not giving money, but you are allowed to, you are permitted to purchase shares 300,000. You don't want to put money. Later you have to, when the settlement date comes, you have to. But now you don't have money now. You are intending to purchase a share now. You have a portfolio of 1 million. Then the broker credit is anyway available. Right? If you are working on, if you have invested in shares, when you're working on when you are using the online platform of this particular broker, you can go and buy yourself without telling the broker. Without telling the broker, you can have your own purchases through this online platform. Now, online platforms means now when you want to invest in shares, you have to go one of these broker name. So that this particular broker company gives you their system. So then you can personally buy it without telling the broker. Right? So the how do you buy based on the broker credit? You don't have money, you have not put money, but you are allowed to purchase. Example, I told you, say 300,000 worth of shares. That is broker credit. So what is margin trading? Margin trading is something different. Margin trading is basically giving by the. Sometimes there are 15 margin traders in the in current in current market. Yeah, there are some banks. There are some what you call institutions, private companies also there. Two banks are there. Now the margin trading is basically, in short, you keeping your you keeping the entire asset portfolio or whatever asset portfolio with the bank and giving loan. That's all. That is margin trading. That is margin trading. But here the structure is different. So if you have 1 million share portfolio, you are also take a margin trading. So then there should be agreement between you as the investor, bank as the leverage provider, and also the brokering company. There are three-party involvement agreement, tripart agreement to sign under this margin trading. What happens is when the share prices come down, so the margin provider has the right to sell. Margin provider has the right to sell and recover his සාමාන්‍යයෙන් දෙන්නේ total portfolio එකෙන් 50%යි. 50 දෙනකොට මොකක් හරි ෂෙයා එක අපි කියමු price එක 100 කියලා. මේක වැඩනවා එකපාරටම 90ට. Then security value has come down. What happens is at the reach when the margin provider with the bank sells shares. Now you must have heard sometimes. Now month end, now when the prices come down, so the brokers are selling margin call. Have you heard this margin call mean what? So the margin provider, the funds provider, banks or somebody tells their whatever the price, you don't need the investor's consent. Whatever the price, available price, they sell it. So what happens? When you selling, obviously more supply coming down market. So you must have heard this word margin calls, and so sometimes it happens, right? So there are occasions like that. Right? So that is margin trading. So there are few mechanisms there. And the margin call, how much margin has to be called. If it is 50, it becomes 40%. Then you definitely cut the share price, cut the share portfolio. That happens, right? To recover you. Financial brokering is also the similar. Brokering is actually legalized profession in terms of this, right? Very sharp. And what else the brokering involving? Then the arrangement fee. Have you heard when you arrange whatever the now when you speak to when you talk about international funding arrangement, now like loan syndication. Now the government of Sri Lanka is planning to invest have to issue ISB, international sovereign bonds. So then here they appoint several banks, which is the how do you call them, book runners, right? Or the we call them arrangers. So then by arranging these, the issuer has to pay some percentage of the total offer amount. So that's the arrangement fee. We call basically brokerage. Arrangement fee is that. Arrangement fee is that. right? Proprietary trading we discussed with you all. Basically, we discussed foreign currency matters. So that part is not much relevant to us, but I thought of having discussed you because examiner has several times tested on this foreign exchange. I think this time also there may be a huge possibility, a big possibility to check your knowledge on this foreign exchange. Forward exchange contracts, the ban, we are under dollar, tremendous pressure on the dollar, liquidity and everything, based on everything, then there can be a question on this. And also we learned if you are given a two currency pairs, how do you arrive to a how do you arrive at cross currency? That is also important for you to understand or keep in mind. Just go and look at the notes and what is the method that we have suggested. If it is too direct, if it is too indirect, and if it is direct, indirect. So what is the method? It is straight line multiply or the cross and multiply. So you go and see, have a look, and these important things. And I have done some questions with you all, and some questions are available in the notes as well. You can try these questions, and also then important parts we discussed the hedging instrument. Remember, hedging is what? Hedging is basically you mitigating the risk of foreign exposure, foreign exchange, foreign exposure risk mitigating matter. So then we have discussed internal, external. Internal we have discussed several. External we have discussed several. Internal methods of currency, basically the pricing for local currency, then the leading, lagging, those things actually not in existence, right? Not in existence, internal method, but external methods, of course. Forward exchange contract is the most popular. Then you have option, you have futures, then you have swaps, all those things. Then we discussed polar, flow, and cap. And words are important, the terms are important, if someone can test you. And options we discussed two things, especially the call option and put option. In the option types, Bermuda option, right? Vanilla option, right? Those things also important for you to understand the American option, Friday. Important things, right? Just go and have this. Then not tested the examiner this. How do you have this premiums and discount? Now say if you going to if you are going to import a vehicle today, you enter into a forward exchange contract. Personally, it's banned, right? Momentary scenario, what's happening in the situation. So the forward exchange contract. Now, when you agree with the bank to pay after 3 months time. So today 200, agree to pay 203. What is the 3 rupees? The premium. Right? Remember we discussed premium. Some countries have premium like Sri Lanka. Some countries have discount like Japan. We discussed. Then how do you decide this 3 rupees? Based on the interest rate parity and the purchasing power parity. But here we are much using interest rate parity. So I have given some small notes. Just go through and that is forward exchange contract. That is forward rate. Now today cash, tomorrow term, day after spot, anything spot we call it what? Forward. Other heta anita cash term spot. Other than spot we call it forward. Right? So how do you create a forward rate? There can be a question. Right? Examiner can give you two countries interest rate. Right? So remember we did discuss USD LKR and LKR interest rate good. Then you divide this LKR interest rate by USD LKR, then you get it. And spot rate into this rate. You get what? Forward exchange contract. Forward rate. So that is also important. The difference is premium or discount in this matter, right? Depending on the interest to decide So then forward exchange contract, then the important thing is just go through this hedging instrument as well. Then we move to mergers and acquisition. The capital restructuring. Mergers are you get together two companies, existing two companies are vanished. This merger. Acquisition, both the companies are there. You acquire or you purchase the other company shares. So then what do you mean by uh, associate and subsidiary? Associate means we have holding 20%, it becomes an associate. If you holding more than 50%, it becomes a subsidiary company. But without having 51%, if you can maintain the controlling power on the board, so basically appointing more directors on the board, then you are maintaining. So basically that particular company is a subsidiary company of you. The company has මට directors ලා board එකේ directors ලා ඉන්නෝනේ 5 දෙනා. Articles of association එකේ තියෙන 5 දෙනායි. හැබැයි මට පුළුවන් මට 51ක් නැහැ. ශාස්ත්‍රව මට පුළුවන් මොන හරි ක්‍රමයකින්. ඒ කියන්නේ මගේ ඉන්දිරෙක් ගිහිල්ලා මොන හරි ක්‍රමයකින් මම හිතන්නකෝ 42ක් මම මේන්ටේන් කරනවා. හැබැයි අනෙක් කවුරුත් 42ක් මේන්ටේන් කරන්නේ නැහැ. So even I don't hold 51, I am the largest shareholder. Then I have the power. So I have the power to appoint more directors. The meaning is what? Basically you are controlling. So then you become subsidiary. Not from the shareholding percentage wise. But there are many methods you can control, you can exercise your controlling power on a particular company. Now necessarily it is not necessarily the 51% take ownership. Okay. Now then we normal investor, if it is less than 20%, we call it normal investment. Right? Then when you're doing when you acquire a company, you need to pay purchase consideration. Right? So how do you acquire a company? How do you decide the price? Through due diligence. Through due diligence. Right? So due diligence, I have given you methods, the steps. How do you do a due diligence? There was a question in your latest question paper, the due diligence. Right? There was a question in your latest paper on the due diligence. So important one. So examiner will not test you in this time. But frequent question. Now sometimes some questions are there. The previous question paper, the question is there, but this question paper also includes the same question. So I'll show you when you're doing some questions with your the examiner has tested that kind of questions as well. Now see question number 4, the latest question paper, the question number 4 and the sub question 3. Briefly explain what is due diligence audit and outline 3 importance of due diligence in M&A. The 5-mark question, right? And also the investment bankers use different methods of valuation when providing pricing guidelines in M&A. Pricing guidelines means how do you price, how much you need to pay. Briefly explain 5 common valuation methods used in M&A transactions. So we have discussed several methods with you all, remember? So they are asking that only. So that's that. So very frequent question, examiner can test you this time as well. And also the pre-defensive and post-defensive. There was a question based on this 2-mark question. Latest paper, 2020 January. 2021 January. Right? So important that so understand. So then we discussed the capital restructuring part also. Capital restructuring part also we discussed. This one, restructuring the capital and trouble companies. When you're making continuous losses, how do you turn around the company? Then the wealth management is what? So the wealth management is the broader picture. Wealth management consists of many things: asset management, fund management, Portfolio management, everything coming under wealth management. Wealth management says the entire broader picture. Not only the management of assets, giving tax advisors, giving accounts preparing, everything combined. Right? Wealth management also undertaken by the investment banking division. That is the one of the role they play. So I have given you note role played by the investment bank. So this is one of them. The fund management is another one. So basically you are giving a fund to manage on behalf of me. You're taking a fee. So the portfolio management is coming under this only. Don't put all these into one particular investment, one particular investment. So then what happened? You have a portfolio. Then there we discuss systematic risk, which is not tested in your exam. Systematic risk common to everybody. Unsystematic risk, it is not common, but it can be avoided. It can be avoided through diversification. Diversification is what? You invest your money different sources. චාන්ස් වල දානවා ටිකක්, ප්‍රෙෂර් බිල් වල දානවා ටිකක්, ඩිවෙන්චර් වල දානවා ටිකක්, risk free තියෙනවා, risky ඒවත් තියෙනවා. So that is your portfolio management, right? Portfolio management, it is not necessary here. So there is a method of portfolio management. How do you decide how much should I put in this particular, right? In diploma, now last week I did a lecture for a diploma banking people, and they are actually the interesting part is the important thing is the deployment of assets, deployment of your funds in high yielding. But when you want to do that, when you need to earn more by investing your money, but only thing you have to be very careful about the risk of losing your capital. Now, if I get a question, the senior citizen, he has, we say, no, retired guy, he just retired. He got all these terminal benefits, right? ETF, everything he got. Now he's trying to invest. Everybody was talking, I'm just reading a question, right? I'm just telling you a question. Now everybody was talking about investing in share market. Then he also decided. So are you recommending? Those are the questions exam test. To read the question number, the last question from 876, these are the type of question, but very easy, nothing. So story type, but nothing in it. Very much irrelevant questions. So when the student sees a question, the lengthy question, the text type question, so which consists 5 to 6 lines, sentences, 5 to 6 lines. So then you get stuck. Then don't be distracted. You read this question, nothing. Right? So the question is now, do you recommend? So obviously you should not recommend investing in. Why? There is a risk of the word. Remember the word. So reuse the word. The risk of losing the capital. The amount you invested also can be lost. Other the higher gonna share return of finish. So what do you expect from investing in share market? What do you expect investing from share market? Dividend. You expect from dividend from the share market, right? But plus you are expecting what? Expecting what else? Dividend plus capital gain. You can sell the shares before it gets matured. There is no maturity. You can sell the shares at any time. If it is making profit, then you earn what? Capital gain. Capital gain plus dividend, right? So then basically you can earn two types of investments, two types of investment income by investing in shares plus debenture. Now remember, in debenture you don't earn capital gains unless you sold it. Got it? Now you invest in a debenture for 5 years. You are keeping it for 5 years. Are you making any capital gain? No. You don't earn capital gain. You remember? You don't earn capital, and before you sell only, you get capital gain. Before you sell only, you get capital gain, right? Before you sell, until it gets matured. Before it gets matured, then only you earn capital gain. If you are holding this particular instrument to the end of or until it gets matured, if it is 5 year debenture, you are holding it for 5 years. You don't realize any capital gains, huh? Only the interest. Good. So the examiner can test you based on the purchase sale. This is today's current sale. Are you recommending to sell? If it is if the investor wants to make capital gain, you can recommend. Right? The higher then obviously yield has come down, price should go up, then you can sell it. So like that, right? Without calculating the price. So fund management is that. How do you decide where you put this percentage, where you put this percentage, like that, right? Then investment research. So basically, the broker sends you all these company reports. So there you can get the investment to hold, investment to sell, investment to buy. So there you have buy recommendation, sell recommendations, and hold recommendation. So all these three things available in this investment research reports. So if you are an investor, if you have investment in shares, so the broker sends these frequently, these reports, right? Security analysis is based on what? So how do you decide to invest in this particular share? So remember that we discussed the price earning ratio is the screening method, right? Price earning ratio. How do there is a? I think I'm not sure whether I have uploaded this particular one. The first I will again upload, but I couldn't find out this particular one. It says ratios with y'all, ratios to y'all, and investor ratios and dividend yield and all those things. So the price earning ratio is what? Market value divided by EPS. Market value divided by EPS. So the lower one you select. Frequent question, right? Examiners frequent question. Which one you select? There are two types of securities. Make a P ratio measure and make a P ratio. So which one you select? The lower one. So what do you mean by that? The amount, the time you taken to recover your investment. Which one you like? Lower the better, right? If you want to recover and better, you go for that. Right? That is that. So the project appraisal, we did it with the second topic or third topic after we finishing treasury bonds and similar thing. So basically, only thing you have to keep in mind how the project is appreciated, appraised. Now, question number. This is the first time. This is second time examiner has tested this question. I'll show it to you. Question number 8. 2000. We'll be doing later. I'm just giving you kind of relevance. 2021-21 net present value. Remember, net present value. So basically, how do you decide the project is viable or not based on the net present value? If it is NPV is positive or plus, you accept, you go for this. If it is negative, you don't accept, right? Then there we discuss what. So then if there is a project, you earn capital, you earn cash flows. Then how do you discount? What do you mean by project appraisal? You bringing all these cash flows into today's term. Similar to treasury bond. You can't take decision. You bring all these cash flows into today's term. How do you do this? You discount. So remember that if it is a company, company is going to acquire a project. Company needs to evaluate this project is viable or not. So then project cash flows are there. Project expenses are there, cash inflows, cash only the cash flows we are taking, not the non-cash flows, we are not like depreciation, like provisions, we don't take. Inflows, yeah, outflows, cash flow. Then how do you discount? How do you find the discounting factor? Then methods we learn. Remember? What do you mean by that discounting factor? Here we how to call it? Cost of capital. But in terms of the treasury bonds, discount same thing. But the two scenarios, treasury bond valuating, pricing, here projected value. If it is projected valuation, we call it discount is the one. Cost of fund. Cost of fund. Otherwise, WACC. WACC. Weighted average cost of capital. Weighted average cost of capital comprises basically two, but we learn three. One is what? Cost of equity. The other one is cost of debt. Then I have again told you cost of preference shares. Right? This comprises cost of the weighted average cost of capital. Calculate the weighted average cost of capital, discount. Now treasury bond, discount effect is what? Your thinking. මට මේක කළොත් බොන්ඩ් එකේ මෙච්චරක් හම්බ වෙනවා. අබ F3 lemon මෙච්චර. I need this. Your personal thinking. There is no method. I have 20%. But I can have 50%. Okay. At least I need 50%. Then you do the discounting 50%. That's right. But here there is a method, more methodical method. So if it is a company, you are going to undertake a project, then you calculate the cost of equity. So to calculate the cost of equity, there are many methods we learn. CAPM, most popular one. Frequent question based on that. Risk-free rate plus beta within bracket market till minus risk-free. Within bracket part, separate word also we learn risk premium. Beta is the measurement of what? Systematic risk. Risk-free rate is what? Either treasury bill, either treasury what? Everything has to be given. This is your discounting factor. That is one part. Cost of capital, cost of equity. So then what's the other method? Dividend model. So many dividend models, if it is a growth, if it is a constant, we discussed, and I have discussed with a question, particular period fixed from this point onwards variable. I have not discussed it, but only thing I will take it there as a question in the exam. With that question I will discuss. Then we move into cost of debt. What's the difference between cost of equity and cost of debt? The salient feature is what? Tax adjustment is there. So that's where you go wrong. So don't be distracted. If it is debt, there should be a tax adjustment. So after tax figure only you have to take. You got it? Divided by P. So it has to be, if it is dividend 10%, you have to pay after tax. Then what happens is then you have cost of equity, then you have cost of debt. You add together. Then you have what? WACC, weighted average cost of capital. Add together means can you add 10% and 20%? You can't do that, right? Add means what? Like we did. Remember that we discussed how do you find out the weighted average cost of weighted average treasury bill rate. Now, when the government, when the central bank publish every week, it says weighted average. Weighted average. Now here, cost of equity you get 10%, cost of debt you get 12%. So basically, how much the capital, how much debt, you weight it. Remember that we did it, and we remember I conducted extra class. Then I showed it to you. How do you do this? Based on the capital structure. Based on the capital structure. There was a question, similar question in the exam. Right? 2021 January. So it basically what I want to tell you is, if you learn, if you study the notes which I give you, you can easily pass this exam. Right? If you have a kind of what you call this interest in learning, I think it's very easy for you to pass this exam. Only 46 marks, so you have to get it, right? So then, so I just wanted to give you a nutshell what we have done so far with you all. So you can pass this exam, right? So I have missed something also probably, but I wanted to give some kind of refreshment for you. How do you what we have done, and I showed some questions also from the latest question paper. We can do that. Many questions, right? If you see this latest question paper with yours, so the right issue question is also there. Now if you see the question number 3, I think it's uploaded to you, right? Question number 3, subpart 5. Now the 1, 2, 3, 4, 5, 6, 7 sentences. I'm sorry, 7 lines, but nothing in it. Now already to now PPC PLC listed company is looking at various sources of financing available to fund one of their future projects. Now that sentence is irrelevant. We don't need. Management and the board of directors decided the best method of financing the project is through right issues. Now see now there are many methods to raise capital, right? We learn, we discuss. So then why do you want to go for right issue? Especially you need to protect the existing shareholder. What happens? When you issue new shares, if new guy comes, existing shareholders percentage is diluted. But plus, remember, even I'm a shareholder, even I'm getting entitlement, but if I don't subscribe rights, again, my shareholding is diluted. So that risk is there. There are two types. Why shareholders don't like to dilute their shareholding by issuing new shares to outsiders. So they decided to allow existing shareholders to invest under which right? Preemptive rights. Many rights are there to ordinary shareholders, which we discussed. So this preemptive right basically coming under the one of the rights for ordinary shareholders. So the right issues are method of issuance or the method of getting funds under the preemptive rights. So the existing shareholders are issued. So the examiner can test you what are other methods. Obviously, you can issue rights. You can issue new shares to outside. Then the debenture, then the bank loan. Many methods are there, right? But there are pros and cons by issuing or the adapting several methods, right? Company is confident that the right issue will be fully subscribed given the track record of the company. Irrelevant sentence. Now I have read 1, 2, 3, 4 sentences out of 7. Now this is the only relevant part. Now see, TPC is currently trading at 50 rupees. Current market price 50. Tomorrow is the X right due. X means what? Remember the X due and cum due. X means without. Cum means inclusive, including. You always take which one? X right. X whatever X due, X right. Okay. Tomorrow is the X right date. Rights are issued at 40. Is it right or wrong? Market is how much? 50. But the right is going at 40. Correct or wrong? Right is what? Issuing shares to the existing shareholders at a discounted price. So the 50 is the market. Now the company decided to issue 40. Everything is correct. And what's the ratio? One right for each 5 shares held. One new only for 5. I'm sorry. One new for existing 5. 1 for 5. So he is asking outline two advantages of right I outline two advantages of right issue as a source of funding. Why do you want to issue rights compared to other sources? And why do you want to issue rights? So basically that. So exist now, which we discussed, right? Dilution of shares, dilution of percentage. You don't want to have others to come into the system, come into the shareholding arena. Then the going at discount price, that is also beneficial to the existing shareholders, right? Based on the information provided, calculate the theoretical expected share price after the right issue. So your calculation. So only two sentences are relevant for our calculation, but that's why I told you. So there are 7 sentences here, 6 or 7, 1, 2, 3, 4, 6 sentences here, 6 lines here, but only 1 or 2 lines are important for our calculation. So so if you read this, everything we have learned here. So nothing in it. And apart from this, we have learned how to how to create the rights per share, rights per value, and also remember the minus share price and the rights issue price. Examiner has not tested that. That is also can be tested if they are getting a question on this rights issue. So very easy question, can easily answer questions, right? So I thought of doing some questions with you, but I just wanted to give a recap with you all. And so basically, I need to start questions with you all. 2019 September, I think it's uploaded to your portal. 2019, question number 4, question number 6, question number 8. All these things are text type questions. Then the question number, the 2021, question number 6, question number 2, and question number 3. And the 2019 question number 7 initially. So then we can cover up many things, right? So any question you need to clarify, any gray area you need to clarify before we start the questions from your examination previous papers. And only thing, I will be uploading some questions for you all, the target questions as well, probably a later part of but only thing, I am not requesting you to attempt all this. Actually, when we doing a physical exam, I used to give some 2 mock exams with you all. But only thing is we are not meeting physically. What we can do is I will upload these things. Now, basically, the other days, that is 2 years ago again. I just gave a time, and they actually answer this question paper. It's very like you are basically sitting in an examination environment. So then the Menako will collect the papers, and I will correct and give the feedback to all. So that's how we did it. But only we could do this last few years and last 1.5 years, 2 years probably. And I will upload the same question paper to you, what we have done previously, and also the targeted questions. You also then you can go through in advance. So that's my plan. Why then we will be touching this exam questions as well. So I will not take much time to complete this exam questions, because you can do these things, right? So new questions we will try to do this, right? So any question you need to any area you need to further clarify from your side? You need to clarify any further things, any gray area you need to satisfy? මන්දිර කෑ ගහන්න එපා, මම ක්ලාස් එකේ ඉන්නේ. Anything you need to clarify? Any areas you need to further
Up to now, no, sir.
Right. Okay, then I just gave you, I think, 2029, 2019 September papers and 2021 papers. So I will take one question with you all. Then these questions get ready and come next time. I will take one question with you all just to give an 2019. I think it's uploaded to your portal, right? Now see, now this is the latest paper. You have now see this is 2021, 2020, 21 January paper, right? And it's been uploaded to you all. Question number. Now this is now see this is test type question. If you have go through no text type the multiple choice question. Which of the following method is not a suitable method to raise capital? Right? Right issue, in IPO, private placement, all these three methods, you can have fund, you can have money, but through bonus issue, can you get money? You don't. It's only a what? Transfer of reserve to capital, right? 2 mark question. And this is the question I told you, pre and post defensive mechanism. Right? 2 mark question also given. And now this is there are 10 questions available, but these 10 questions, this is question number 2. These 10 questions now until question number 8. The multiple choices are given. Out of these 4, you can select one. But see the last 2, you have to write it. Price earning ratio is one of the methods, one of the commonly used ratios to evaluate the company by investors. This ratio is well understood by the investor community due to its simplicity. And however, it has two drawbacks when evaluating the company. State 2 drawbacks of using PE. Now, PE ratio is, how do you find out the PE ratio? Market value divided by EPS. Now, EPS is, how do you find out? Profit after tax divided by number of shares. Now, what happens? Profit after tax becomes minus, meaning loss. There is no profit, loss only after tax. So what happens? The ratio becomes minus. There is no meaning for that. There is no meaning. When the ratio becomes minus, there is no meaning. So that is a drawback. So if you are making losses for a particular year, this EPS becomes minus. So then no use of you. And also when you issue shares particular year, what happens? Profit after tax divided by number of shares, ordinary shares. So when you issue shares particular year, you supply the number of shares, the formula's number of shares numerator or basically I don't know, numerator or denominator. You basically divide profit after tax by number of shares, ordinary shares. When you issue more shares particular year, the number of shares is going increase. That is increasing. So then you have very few amount as an answer. As an answer, you get a very small value. So when you say now you get 1 rupee EPS, You get 1 rupee EPS, then you market price divided by 1 rupee is going to be this aspect. So basically you are getting mislead that part. So that is the examiner ask you, but this time examiner can give you two types of P's of two different charts and asking which one you should select. So that is will come later. Then question number, I just want to do one question with you all. Question number 6. Now see the text of this particular question. Question number 6. This is your latest exam. Latest exam question number 6. Now see the second question. The length of this particular question. Now shall we read this second part? I just want to give you idea. This is nothing in it. Now, you can see this, right? Mr. Kanakaraj is an employee of a leading bank in Sri Lanka. He has accumulated his wealth in an equity portfolio during the employment period and will be retiring at the age of 65, which is due in 2 years. At a point, retire now. His employer does not have any retirement benefit scheme for its employees, and any retiring employee will receive statutory benefits such as gratuity payments, employee provident fund, and employee trust fund at the retirement. Again, gratuity කියලා කියන්නේ ඒකෙන් පස්සේ මොකක්ද ඉන්වෙස්ට්මන්ට් ප්ලෑන් එකක් නැහැ. බැංකුවක් එහෙම එකක් නැහැ. but ඔක්කොම යට හම්බ වෙනවා. Employee provident fund during the last decade, equity investments have given substantial return compared to fixed income security investment. What do you mean by fixed income security investment? Fixed income security investment, treasury bill, treasury bond, debenture, all those things are fixed income securities. The Kanakaraj has most of his investments in equity market and enjoying the benefits of the market performance. So it's better. Your value of investment is also increasing when the market performs well. So what are the two indices we have in the share market? ASI and S&P. ASI comprises all these shares, but S&P consists of highly capitalized shares. This composition is regularly changed. S&P index or the number of the share counter, the shares frequently, not frequently, but it can change. But, right. However, now and also another thing is bull and bear market. Right? Bull market is what? Price increasing market. Bear market means price coming down market. And yeah. Yeah. Basically, when the purchases is coming more, when you have more purchases, the market is becoming bull market. So, when the purchases are there only, ASI and S&P increasing or going up. A index එක උඩට යන්නේ purchases තිබ්බොත් විතරයි. If everybody wants to sell, then the market comes down. Now what happened? No, you see now with the policy rate increase, what happened? Investments or the FDs or whatever the other bank products interest went up. Then ඔක්කොම බැංකුව වගේ FD වල පොලි වැඩි කරලා පොලි ප්‍රමාණය වැඩි කරලා. Then what happened? The relationship is from the share market, then you move into these products. So the share market is coming down. Actually, it has happened several times. But now there was a rate decision. There was a monetary policy decision Friday or Tuesday or Friday. I think it's Friday or Wednesday, Friday or Thursday. Exactly remember the day. But what happened? The decision was what? To maintain as it is. So there is no policy rate increase further, policy rate reduction further. Recently they increased by 0.5%. That's true, but people were expecting from the central bank they will increase or they will decrease, but decision was to maintain as it. So what happened? It is kind of boost to the share market. So the prices of the SI and S&P started to went up. So like that, it's basically there is a interrelated fundamentals. Interrelated fundamentals. Share market on the interest rate add වෙනකොට share market එක මිනිස්සු move වෙනවා. Even at high risk. It doesn't matter. Even at high risk. Right? However, it should be noted that equity market investment performance was subject to longer term investment, where higher returns were generated for investment that were held for minimum 5 years. Now, some people are coming to this market, share market, quick gains. I will leave මාසෙන් විතර ගන්නවා 10% විතර gain එකක්. There are instances like that. If you see the some fast performing share now, I just not to mention the name. So basically, this share was at 2 rupees. Now it's coming under 190. So the most popular shares among investors, right? So can you imagine? It is basically it has not even there is no 5 years. Recent past only, right? At least you can earn 6 rupees per day sometimes. So there is a method. There are invest, but there are actually you should come into investment in investing in share market with the intention that you should hold at least for some time. So meaning is what? You should invest in share market with your own funds. Borrow and investing is not going to work for your life. So a lot of people borrowed funds, invested in share market. So that disaster sometimes, right? Sometimes disaster. At least if you have earned something, then you can invest in share market. So our recommendation not to invest in borrowed funds, right? Kanakaraj is expecting to invest his salary benefit fully in equity market once he retires. State whether his investment decision is appropriate considering his age, employability, liquidity requirements, and risk. So how many lines are there in this particular sentence? But actually the essence is what? 65-year guy, senior citizen guy investing in shares. Do you recommend? What is your answer? No. You don't recommend. If the examiner asks you, he is senior citizen, he is going to invest in shares, do you recommend? Your answer is what? No. Same question, repeated, or the structured in different way, same answer, you have to write in differently. Simple. But this is the least number of answered question in your exam. Some students have selected this particular question number, question 6 neither. 6. But this is the least number of answered question. But if 100%, I am 100% sure students have not read this particular question. Students have not read this question. Why? Sometimes they don't have much time. So 3 hours, 3 hours, so that is one reason. Another one, this kind of question, if you get it in a paper, definitely you get frightened. So that's why I want to tell you, this particular paper, even you get this kind of question, the lengthy questions, so those lengthy questions are the easiest questions. Now, if you see the first 10 questions, if you don't know the answer, you can't earn marks. The best method like finance if you don't know the answer, bonus issue Salary generated is just a transfer of reserves to capital. That is your luck only. But here, if you heard something, 65 years old, okay, once you invest in share market, you might lose it. 65 years. And also, similar question, the pension funds. Now, you know, ETF, if you see the today's paper, Sunday Times paper, that the first line of this first page paper, ETF has invested in Laugh Gas, and they have incurred huge losses. So the pension funds, you don't recommend to invest in share market. So by reading the papers, also you can get something. That's why I told you to read papers, especially the business papers. Right? It's important. So the ETF, we are not recommending to invest in share. Why? It's a highly volatile market, high risk. So whose money is they are investing? Our money. Right? So investment funds are generally not, now they do on the but now it's true that now they have, now the ETF has huge investment in what? And the Sri Lanka Insurance also has huge investment in Expo Lanka. So they are making huge profits. So actually the people are not talking about the making profits. They only talk about making losses only, but they have enough and more investment made in these good shares. They can cover it up. We don't need to worry about that. They have put it like that. But the true while Laugh is not performing well. But this has been the investment a long time ago, right? So obviously. So the share market you can't make profits. That's obvious. Everybody didn't come and invest in it. So then don't even loss lighting even that is their media. So that's different. And you can earn profits by investing, but high risk. You make investment by knowing risk. Now this guy has a problem is what? He doesn't have any other living mechanism. Only thing, ultimately the amount he got out of this ETF is the only saving, only income source he has. Now this finish means what? Disaster. He doesn't have anything. So actually he needs to protect his capital plus the return. So by investing in share market, can you protect the capital? You can't. It may be generally difficult. If the share prices come down, you will lose it. It's a risk. So basically, this type of people cannot be taken. This type of people, we should not advise to take risk. Why? They don't have any other means of living. So basically, your answer should be in what is the state whether the investment decision is appropriate. It is not appropriate. You should actually instruct them to. Now, you can't say no. Why? It's a 5-mark question. At least you should say something. I think you should say something, not lengthy, right? So in the exam paper also, it says you should have very short answers. But at least if you can answer to the point, that is more than enough. Provide precise and direct answers. So if you don't know, then you tend to write more. So that's not going to work. So that's easy question. That is the most lengthy question in this paper. I just selected one to do. So we will continue from next week. Just go through this question and have a look and come. Any question you have? So then we will wind up the class. Thank you very much for being with us. We will meet next week, right, for the questions, answer and questions. Right? Thank you very much.